Good afternoon, ladies and gentlemen. It's Jesse Colombo, Cyber Trading University's Forex and Futures instructor, and I'm excited to have options expert Larry McMillan on our closing bell today. He's going to be discussing a topic of trading volatility, and there have been many listed volatility derivatives since 2004, but most traders don't understand how to use them properly for protection or speculation. So he's going to be showing how to use VIX futures and options as well as other popular options, ETFs and ETNs. So definitely looking forward to it. Larry, thank you so much for coming on.
Thanks, Jesse. Can you hear me all right?
Yes.
All right, good. Yeah, as Jesse said, today we're going to be talking about trading volatility. Um, just a quick word about our company. There's three facets to our company. One is we manage money as both a RAA and a CTA. We also do a fair amount of derivatives research in terms of newsletters and things, and we have option education, things like this seminar. The PDF of this presentation is available for free on our website at optionstrategies.com/cyber if you're interested in downloading. All right, well, we're going to talk about volatility. So there's two kinds of volatility to at least to an option trader. And the one is, how fast something has been moving around in the past. That's historic volatility, or sometimes called statistical volatility. And pretty much everybody agrees on what that is. But option traders are forced to make a forward look too, a forward guess at volatility in order to price options. And even though you may not realize it, but every time you buy or sell an option, you are making that implied volatility estimate. Now, you may just be going along with the market maker and whatever he has in his estimate, probably you are. But in general, you should be aware of the implied volatility that you're paying for an option. So way back when options first started trading in 73, I was actually trading them then. The Black-Scholes model had just been invented, and everybody thought, well, this will, or at least smart guys thought, well, this will be great. We'll just use the model. We'll determine whether an option is overpriced or underpriced compared to its fair value. If it's underpriced, we'll buy it. If it's overpriced, we'll sell it, and everything will be wonderful. As it turned out, that really wasn't possible because you don't know what fair value is unless you know what volatility is going to be. And so you have to predict volatility in order to do that. That's just almost as difficult as predicting stock prices. So today in the modern world, traders don't talk that way, professional traders anyways. They'll instead talk about the IV, the implied volatility of the option, and they'll say whether it's low or high. So if we say implied volatility is low, then options are cheap, and they've been cheap for the last few months. When implied volatility is high, we say they're expensive. So what causes implied volatility to rise? Well, a day like yesterday in the stock market, takeover rumors, FDA hearings, lawsuits, any of the kind of things that might cause a gap move in the stock itself. So the CBOE quantified volatility in 1993 when they designed the VIX index for the first time. That was actually designed by Professor Whaley at Duke University. His name's going to come up later in this presentation. In 2003, they changed the way the VIX was calculated to use two strips of options. In other words, all the striking prices from very low strike to very high strike, so a long series of options. And they used the two nearest strips to create an average 30-day volatility estimate. And that's what VIX is, a 30-day volatility estimate. They changed it slightly in 2014 so they could use the weekly options. But again, it's still a 30-day volatility estimate. So in terms of how VIX is calculated, this is sort of a graphic demonstration of over here on the left. You can see that this is the two strips of options. There's one strip right there, and then the other one next to it. And they use all of the options in the calculation. It's a fairly complex calculation, probably not something you want to attempt yourself. But it does use SPX options to make these VIX calculation. So that's the basis for this. And again, very importantly, it's a 30-day volatility estimate. And when we talk about trading these products, you'll see why we have to try to approximate or at least stay within a 30-day time frame. So a VIX is just a formula. It can be computed on a number of things. In other words, the one that we normally talk about VIX is really SPX VIX because it's using SPX options. But CBOE also has one using the GLD options, and that's a gold VIX, or the USO option, that's an oil VIX. There's also a whole a vast array of these. You can go on the CBOE website and look these up. But these are the volatility calculations for these various things. So there was gold, as I mentioned. There's also silver, the USO, as I mentioned. The euro, that's been a very popular one recently. Using the Chicago Board of Trade Futures options, they calculate one on T-bonds. They have the euro, the pound, the yen. The yen one uses the CME currency options. There's a series of stocks even. They calculate a VIX calculation on these stocks every day, continuously, really. And also on these various indices here, some of which are quite quite volatile and interesting to look at. So each one has a different symbol. Where VIX is the obviously VIX, that's the one for SPX, but the others you may not know. But if you want to quote look them up, you can find them on the CBOE website. But just because the index is published doesn't mean there's any futures or options to trade on it. In fact, right now they've just delisted some. So right now we have futures and options on the S&P 500, obviously the regular VIX, also on the T-bond one, and on the Russell. All the other ones that they had, they've delisted for right now. So here's the history of VXO. The original VIX in 1993 that was replaced in 2003, they still calculated, they used the old symbol VXO. They used the symbol VXO. And remember that I said VIX was created in 1993, but they backdated this one all the way to 1987 so they could see where VIX would have gone in the crash. If VIX had existed in the crash of 87, it would have gone to astounding 150. But even in the financial crisis, it did go to 103 VXO. So the point of this chart is to show that when the market gets in trouble, VIX explodes to the upside. And it explodes a lot faster than you might think, especially in a very nasty kind of market. So like yesterday, for example, the S&P was down about 2%. VIX was up about 35%. So, and I know it's coming from a low level, would have trouble keeping that pace. But VIX will go much faster up than SPX goes down when it moves. And again, that's something we'll talk about in a little while when we talk about protecting a portfolio. But I want to start off with a very simple signal, very useful signal, though quite successful. And it's simply this. If the market is collapsing and VIX is spiking up like this, then you wait for VIX to make a spike peak, and that forms a buy signal for the stock market. And I'm going to quantify this for you. But what's pretty interesting about that is we're in that situation right now. These are some old VIX spike signals back from the 70s, 97 to 99. This one here was the first time that the market, the only time actually, the Dow had ever closed limit down. There was a limit on the Dow, just like other futures contracts, and that's the only time the Dow ever closed the limit down. The S&P futures did hit the limit on intraday, overnight basis once in 2008, 2007, actually, but that hardly counts. That was a smaller limit. Anyways, there were others. These huge spikes here were in 2008 when we had first the Russian debt crisis and then the long-term capital hedge fund crisis. And I've marked 3 other spikes on there, but there's even more. I mean, you could even mark some of these really low-level ones like, say, like this one here or this one here. Those are both valid spikes as well. So if we just take a look, and at that time, OEX is what these were based on. Those are those same 6 signals, and you can see that each signal is an intermediate term signal. So if you miss it by a day or so, you've still got plenty of room to ride the trend upwards after these buy signals. So this is a powerful setup. But just to say, well, it's a VIX spike, we have to decide what does that really mean. So if in order to backtest that trading system, we defined it as meaning if VIX closes 3 points higher over a 1, 2, or 3-day period using closing prices, then it's considered to be spiking. And as of yesterday, VIX is spiking. So once VIX is spiking, you are going to get a buy signal from the stock market. Now, the next thing we look for is we keep track of the highest intraday level that VIX has reached while it's spiking. So today, VIX traded up to 1980. So that's the highest level so far that it's reached in this spiking cycle. And the buy signal itself comes about when VIX closes 3 points lower than that highest intraday spike peak. So right now, the highest intraday peak that it's made in this cycle is 1980. So a close by VIX below 1680 would be a buy signal. Once the buy signal is in place, our system has a stop out. If it goes back and closes higher than 1980 later on, that would stop you out. Otherwise, we hold the trade for 22 trading days, about a month. I'll show you some statistics on the system in a minute. So this is the current VIX chart, and we had a spike peak buy signal back there in October. Then we had a series of them actually here in December and January. These were all pretty successful. The market went up after every single one of those. Now we're spiking again. So this is the first time we've had a spike peak since February. And I expect it to be a pretty good signal when it occurs. This is the track record buying an at-the-money SPX call. If you want to, so the average price of an at-the-money SPX call 1 month out is 37.60. If you're talking SPY calls, you can divide by 37.6. And our average rate of return here is 17% on the call. Obviously, that's not annualized. That's just straight trading. It's had 54% winners, and you can see that it's made a lot more on the gains than on the losses. Most of the losses, when they stop out, they come right back in after that. Now remember those other indices, those other VIX I talked about. You can use those in the same way. This is the gold VIX down here at the bottom. You can see that it's spiked up and back down at this period in time, and gold over the next month went up about $90. So, pretty good trade there. It's also the emerging markets. There's a volatility index on that. On this one, the volatility index is up here. You see the spike. And while it wasn't as good a trade, you bought there, you had a little bit, but by a month later, you had a small profit. So it's worthwhile watching these other VIX indices, but the main VIX is the best one. Now, the CBOE also publishes a list of volatility indices besides VIX. And I'm just going to briefly review these here because they have some good meaning for traders as well. First is the short-term VIX, which is symbol VXST. You can quote these on your trading systems, just quote it as an index. And it is a 9-day volatility estimate, which I like that. I like the short term because everybody's always trying to trade VIX. As you'll see later, we can't really trade VIX because the computation is too complicated. But at least with the 9-day volatility estimate, there's a chance that you could stick with this. They listed futures and options on it, but they've actually been delisted. Just didn't get enough trading interest. Surprised me. Also, there's the VXV, which is a 90-day volatility estimate, and the VXMT, which is a 180-day volatility estimate. And then the CBOE even publishes this, the VVIX, which is basically the volatility of volatility of VIX. In other words, they take the VIX options and apply the VIX formula to it. So it's almost circular. So what are these various indices good for? Well, it turns out a number of things. In a normal bull market, they'll line up like this. The short term, the 9-day, will be less than VIX, which is the 30-day, which will be less than 90-day, and that will be less than 180-day. But in more turbulent markets, things start to change. And in fact, in a roaring bear market, this happens. They completely invert. So the short-term volatility is the highest, then VIX, then the 90. 80. When you're in this kind of environment, you don't need to be told it's a bear market. The market's going down really fast. But what's happened yesterday was this. VXST rose above VIX, and that rose above VXV. It did not get higher than the 180 day, but it's close. So then just one day, this term structure, if you want to call it that, almost completely inverted. And while it's in the inverted state, that's bearish. So I call this a poor man's way of looking at the term structure because the term structure is really a VIX thing, but a VIX futures thing that we'll talk about that a little bit later. So there's another buy signal that occurs when VIX crosses above VXV. The 30-day crosses above the 90-day. That means the market's getting oversold, and it can stay in that state for a while. But once it comes back out, when VIX crosses back below VXV, you get a pretty good buy signal. Here's the buy signal. As you can see, it hasn't happened too many times over the years, but we had all these signals here were pretty good signals, and that was up through 2014. And then in the last summer, we had one in August, and then we had a couple here in October. I'm sorry, one in October, and then a couple here in January, February, and four of those five were profitable signals. So we're right on the verge of that again. Yesterday, VIX closed higher than VXV, and today it closed lower. So that pricing actually did take place. So last October, we had probably 5 or 6 of these buy signals that came in together, roughly together, with a great rally had coming out of that. Now, there's one other one that we do pay some attention to, and that's when the 9-day, the VXST, crosses above VIX of the 30-day. And this is not a signal per se, but it is a warning that the stock market is going to become more volatile. And we back tested it. Usually the best thing to do when that happens is to buy like a 3-week straddle spot. But just recently, from the 4th of June through the 25th, which was last Thursday, the short term closed above VIX on 12 of 15 days. That was a warning that the volatility was about to come, and of course it has come. Whether it continues is another matter, but it typically does continue on. So I would say probably from this date on forward, at least 3 weeks, we're going to have some pretty high volatility. All right, so how do we trade volatility per se? Those were kind of fun things to look at compared to indices, but what if we really want to trade volatility? Well, in 2004, the CBOE listed futures on the VIX, and in 2006, they listed options on the VIX. And by many accounts, the options on the VIX are the most successful product that they ever launched. There's the futures and options have a sort of an interesting thing. They expire on a Wednesday instead of the third Friday of the month. And in fact, they expire 30 days prior to the options that are attached to the futures. So for example, here, July VIX futures are attached to something that expires 30 days out, which happens to be SPX August options. So when SPX August options expire, that happens to be first. If we backed up 30 days, this is when the July futures expire. So this is just something to get used to. If you're used to trading futures options, you know that they often have odd expiration dates. But this is, clearly just a little bit of a difference from regular stock options. It's important because VIX is this 30-day measure. And we can't trade VIX itself because of those. The market makers cannot hedge those 2 strips of options. So they just hedge 1 strip of options. In that case, July futures are tied to August SPX options. But if we're trying to simulate VIX, the best thing we can do is stay very short term. We want to stay in the near term and roll our products over rather than, say, going out 6 months. And I'll show you why in the next few slides. This is a picture of the implied volatility of OEX options. This is a scatter diagram of different days. And what you really want to notice here on this graph is that an option with very little time remaining can have implied volatilities that are all over the place. It could be very expensive, like a 45% implied volatility, or they could be very cheap, with a 10% vol. Just depending, it wouldn't be back-to-back days, but I'm just saying at different times. But if somebody asks these market makers to predict where volatility is going to be in 3 years, they really don't know. So they're just going to price everything, well, right around the average, what they think is the average volatility. So if options are very cheap today, and down here, say at the 10 level, and we know the market makers are pricing 3-year options out here, then where are the other options in between going to price? Well, they're going to price along this sloping curve like this, and that's called the term structure. In a bullish market, the term structure slopes upwards like that, and in a bearish market, where the near terms are very expensive, the term structure slopes downwards like that. So all you really need to understand from this graph is that in a bullish market, term structure slopes up. In a bearish market, term structure slopes down. And this is going to be important to some of the strategies we use later, especially when we're talking about the ETNs and ETFs trade on these futures. But just to show you an example of how you need to stay short term, let's go back and look at arguably the craziest time, unless you were trading in the crash of '87, this is probably one of the crazier times ever, September, October 2008. And the various colored lines represent where the VIX was with the futures at these points in time. So we start out here, the yellow line is August of 2008. And while we were technically in a bear market, it wasn't a bad bear market. And at that time, VIX was lower. And then you can see the term structure slopes upward. So it was modestly bullish. And VIX itself was trading around 20. The September futures were around 22. And the February futures here were around 23. But then bad things began to happen. Lehman Brothers happened, and other bad things happened, and VIX itself went on a rampage and closed all the way up at 54 on this chart. So if you were in the short term, if you had the VIX September futures, you rode them up to about here, then they expired. You jump over to the Octobers, and you ride them up the rest of the way. So while the length of that the vertical length of that red line is not as much as VIX went up, it's still a good portion of how much VIX went up. And so if you own that as a hedge, you'd be pretty happy. And look what would happen if you just own an option 4 months out, 5 months out, February. In the most excruciating financial crisis of all time, long-term volatility here only went from 23 to 29. Back in August and September and early October. In other words, the longer-term futures are not going to move with you. And that's why I say you have to stay short-term if you're trying to simulate VIX. All right, so we have that point. So along came the ETNs, and these things have become very popular. And Barclays listed the first two of them in 2009. They listed the VXX and the VXZ. VXX uses the 2 front-month futures. So what's really underlying these things is the VIX futures. And they roll them over every day, and they keep the ratio of these 2 futures, they keep it in the same ratio as the 2 strips are kept in the VIX formula. And as time went on, a lot of copycats came around. This is a copycat, this is a copycat, this is inverse VIX, which has become very popular. This is double VIX, so is this one. And you can see that some of these trade some decent size, but nothing really rivals VXX in terms of total volume. So average volume. So let's look at VXX just a little more carefully. Every day, Barclays has to make a change here. They have to decrease the amount of front-month futures they hold, and they have to add to the amount of second-month futures that they hold. This is the way the VIX formula works. So every day, Barclays has to go in the pit at the close, and they have to sell the near-term future and buy the second month. So in the very beginning, the market makers were kind of ripping them off, but that's sort of gone away because Barclays is a pretty big presence in the pit there. But they still have to do this every single day. And this can cause some performance discrepancies. Again, remember, here in an upward sloping term structure, in a bull market, the near-term future is trading here, and the second month is trading here. And every day, Barclays has to sell some of the near term and buy some of the second term. And so it means every day in a bull market, they're paying a debit. They're paying a debit. They're costing themselves a little money each time, each day. And eventually that begins to take its toll. So this is a chart of VIX on top and VXX on the bottom in 2010 and 2011. Well, 2010 was a bullish market, and the term structure sloped upwards all through this period here. And you can see VIX was flat, but the fact that Barclays had to keep paying this debit every day just killed VXX, and it lost a lot of money. Again, here, VIX was flat. The term structure sloped upwards like this. And again, the VXX underperformed VIX very badly. But then something happened. The market wheels kind of fell off. We went into a bearish mode there when S&P downgraded the U.S. debt, and the term structure inverted to this. And now in that term structure, Barclays gets to sell at the front month. They're still selling the front month and still buying the second month, just as they were back, on these other charts here. And they were selling, buying. But now in an inverted term structure, this is a credit when we get to do it there. And so that creates, while VIX was flat across here, VXX actually outperformed. So VXX will underperform VIX in a bull market for stocks and will outperform in a bear market. That's important information to have. Now, we created an article recently. I thought I've got some white papers on a number of these things. If you want them, just email me. But there's if you had shorted VXX on the day that it came out back in 2009 and basically stayed short, this has fallen 99. I'm going to say that 99.7%. In other words, just the cost of rolling that thing forward every day by Barclays is just eating away the value tremendously. Now, whether you could have lived through those two drawdowns in there as a short seller, I don't know. They were pretty big drawdowns, almost 100% and then almost 200%. But in the long run, this thing has been losing a lot of money. So there was a hedge fund strategy in the early days. It was called, just shorting volatility. Called it the big volatility short. Take off on Michael Lewis's book. So the opposite of VXX is XIV. And that's constructed just completely the opposite way. So again, here's the same time period, and here's VIX. And now you can see that XIV will outperform VIX in a bull market for stocks. And again, here in a bull market. But during a bear market for stocks, XIV performs very badly. In fact, yesterday, XIV was pretty much a total disaster. It had been, kind of rising and doing a nice job, and all of a sudden yesterday it was down $8.13 on a $48 stock. So you can see if you get on the wrong side of these things, it can be painful. Anyway, Barclays said, well, rather than you guys buying protection yourself and rolling in and doing all these things, we're going to put some protective strategy together and create a structured ETN out of it. And this trades with the symbol VQT. And I like this thing. I think Barclays did a good job. It's creative. They look at two things. First, they look at the realized volatility of SPX over here on this side of the scale. So it falls into one of these 5 categories. And then they look at the trend of implied volatility. That's important because when the stock market is trending up, implied volatility should be trending down or at least flat. But when the stock market is bearish, when it's going down, implied volatility will be trending higher. So they look at these two things, and you can look up in the prospectus if you want to decide how they find out exactly how they determine the trend. But what they do here is they own two things. They own their S&P total return product, and they own VXX. So when things are very calm and volatility is low and the trend of implied volatility is down, they are 97.5% long the total return S&P 500. Total return just means that dividends are added in. And they're only 2.5% long VXX. But if things get bad and the volatility goes through the roof and implied volatility is trending higher, they will go to 60% long the total return product and 40% long VXX. Now you might think, well, gee, why not more VXX? But as I showed you on that slide back there a while ago where VIX spikes up, VIX really takes off, and that's plenty of volatility protection. In fact, probably even more than you actually. So they created this product in 2010. In the prospectus, they show this back test. This is the VXX here, and you can see that in 2008, it outperformed by a lot. It actually went up because it had so much volatility protection that it made money on the rise in volatility. The S&P 500.
You've heard of a win.
And so, coming into the IPO of this, VQT had a very strong track record. So it started out in 2010, they kind of tracked each other, but then again, 2011, that nasty bear market hit, and VXX jumped a lot, and therefore VQT jumped a lot, and that's this red line, and it went up while the stock market went down. Since then, the stock market has been trying to play catch up, and it sort of has to a certain extent. But the nice thing about the VQT is you can perform the same or better than SPX, and yet you've got this volatility protection built in there. So I think it's a good product for IRAs and other things where you're going to be trading it too actively. Now, UBS came along with a similar one, another ETN, and it trades with the symbol VQTS. And even though the symbol is similar, the products are really not all that similar. So I've heard people say, oh, well, VQTS is just an improvement on VQT. It's not really. It's completely different. In this one, you can be in one of three stages. You could just be long the SPX total return product. UBS can be, but they're managing what's going on in the ETN. Or you could be long SPX and short the VIX futures. That's in an upward sloping term structure. Or you could be long SPX and long the futures if you're in a downward sloping term structure where you really need the protection of the volatility futures. So again, in a low volatility market where nothing's going on, they won't even bother with the VIX futures. They just keep their position in the SPX total return product. However, if the volatility of the actual volatility of SPX is greater than 10%, and it's in a bull market, they will short the futures. In other words, they're trying to participate in that 99.7% drawdown in VXX. On the other hand, if the term structure is sloping downwards like this, and you're in a bear market, then they actually go long the futures. So here's the comparison of the two. This is the S&P 500 down here. So they both outperform that by quite a bit. This yellow line right here is the VQT that we just looked at on the previous. And then this one is the VQTS. Well, VQT outperformed in the bearish market. And the next time we run into a seriously bearish time, it's going to do better as well. But in this long ongoing bull market that we've had, VQTS has not only been long at the S&P 500, which is great, and that's done well, but in addition, they've been short the futures because of the upward sloping term structure, and they've been participating in the big volatility short as well. So it's kind of doubling up, and they've made a lot of money. You can see that. So this is another interesting product. Just be aware that if you're in the VQTS and a bear market hits, there's going to be some kind of bad slippage before it can right itself and get back into where the hedge is really working. Now there's another new product that came out just recently, and these are ETFs. And remember I said that Professor Whaley of Duke University, and now he's at Vanderbilt, had invented the first VIX, the original VIX. Well, he's now come out with an ETF, and he got some publicity because he's behind it. And what they're trying to do here is come up with something that does actually simulate VIX. And in all their marketing material, you'll see that they say that it does. But in reality, not so much. It can, but maybe or maybe not. What they do here is the underlying security here is nothing more than cash. In other words, there's no contracts. There's no futures. There's no SPX. There's nothing. It's just cash. And so VXUP and VXDN each own a percentage of the cash pool, and together they add up to 100%. So And every day they adjust the price of VIX by the same amount that the price of, they adjust the price of VIX up by the same amount that VIX changed. So you do get the movement in VIX. And there's some factoring in there that goes on, to make things come out correct percentage-wise. And the same thing for VIX down. So in a day when when VIX is up, VIX up gains and VIX down loses. And then in order to simulate the term structure, they throw this little thing in here. Every day they take a bit away from VX up and give it to VX down. That's sort of like, kind of like the Big Short. The down gets a little something every day, kind of like what happens to VXX. So what can happen, though, is even with those things, one or the other of these two can end up owning way more of the pool than the other. So they reset them to equal prices at 3 different times. They'll do it on the 15th of every month. They'll also do it if one of the sides or the other rises by 90%. And they'll also do it if VIX rises by 75%. So again, if you're really interested in this product, I wrote a paper on it. But the point is that this can trade well away from net asset value. So on day one, when it traded, the net asset value of VIX up was $25.20. But the actual price of VIX up in the stock market was $27.64, a huge premium. So when VIX did eventually jump higher, VIX up didn't really keep pace too well. So, it's one of those things that if you can buy it near net asset value and you can get the direction of VIX right, you are going to probably approximate VIX more accurately with this product than you will with the futures. On the other hand, there's a bunch of other people who are trying to think of doing the same thing you are probably, and if they've got it priced well above net asset value, then it's really not worth buying. So, so there's some strategies you can use with the futures and with ETNs that actually trade the volatility. By the way, I just want to point out that an ETN is an exchange traded note. ETF is exchange traded fund, and there is a difference between the two. That the note is actually subordinated debt of the issuer. So we saw Barclays was an issuer, UBS was an issuer. Those sound like pretty safe banks, but then I guess at one point in time we thought Bear Stearns and Lehman Brothers were pretty safe too. So just be aware that an ETN could have some credit risk. Anyway, options on volatility were launched in 2006, and they've become a very, very popular product. Now, they have the same expiration date phenomenon. I mean, I've heard of many people buying these options, and then Thursday of expiration week, they look in their account and they say, oh my gosh, what happened to my options? They call the broker and said, they expired yesterday on Wednesday. What? So just be aware that they do expire on a Wednesday. It could be the Wednesday before the third Friday. Sometimes it's the Wednesday after the third Friday. But this is much more important here. That you can take care of just by paying attention. Here, this is a little bit different. The options on VIX trade off the futures as their underlying, not off of VIX itself. At the very last day, yes, they do come into the price of VIX, but during their lifetime, they trade off the price of the futures. And this people can find quite confusing. In fact, I still think quite a bit of the brokerage software gets the deltas.
This summer, take flight without having to take a flight.
Don't price it off the futures. Let me just show you here. This is actually the first day that these things ever started trading back in '06, but the same thing applies today as well. And on that day, VIX was trading at 1146. And I only want you to look at one set of options here, and that's the puts that have a striking price of 15. Do that slop. So I'm going to erase that. So here's your VIX. And I want you to look just at these three actions here. So the first thing an option trader usually does is figure out parity. So the strike is 15, and the underlying is 1146. And so parity here is 354. So with an American style option, which is the way regular stock options are, all the puts would have to be trading at $3.54 or more, otherwise there would be free arbitrage. So you look at these and you see the March 15 puts trading for 3. Well, that's well below 354. And then you see the April, it's trading at 255. That's a whole point below. And then the May is just $2. You can't believe it. You pick up the phone, you tell your broker, buy 100. As you're hanging up, he says, you know these things price off the futures, right? And you go, what? Hey, what? What did he say? Well, they do price out the futures. Separately, just think about this for a second. Suppose we had some stock XYZ, and XYZ was trading at $13.86. Well, and I told you that a May 15 put was trading at 2. Well, that's pretty normal. It's $1.14 in the money if you figure out parity. So it's trading from well above parity, and everything seems pretty much the same here. So that's exactly what's going on here. At this time, when this option was placed at 2, the futures were trading at 1386. And so the option is priced off the futures, not off VIX. As a result, the price of VIX is essentially an irrelevant piece of information when pricing VIX options. There's a interesting statement to wrap your head around, but that's the truth. Now, as we approach expiration, the futures will approach the price of VIX, and on the very last instant of the last day, they price to a quasi-VIX calculation that the CBOE does. But prior to that, they're trading off the futures, and makes a huge difference. So this is a repeat of that original chart. Actually, well, not original, but the one back there that I showed you how much VIX goes up. So in this case, when the market goes down. So what I want you to take away from this chart is that if you long volatility and the market goes down, you're protecting your portfolio. Well, let's talk about protecting our portfolio for a minute. Most people, when they want to protect a portfolio, just go in and buy index VIX. I'm claiming that a VIX call is actually a better hedge. Let's take 2 weeks ago. Let's say VIX is trading around 12 or 13, and let's say the futures were trading around 14 or 15, and you go in and you buy a VIX 20 call, as a hedge. Well, then the market goes straight up. Compare that to a guy who bought an SPX put. The market goes straight up. Any SPX put you bought is pretty much worthless and not even going to do you any good if the market turns around and goes down, unless it goes down a lot. The VIX continues to hang around at that low level. Well, if anything bad happens, VIX is going to blow through 20 in a minute. We go to 30, even 40, 45 in really bad times. And so anything with a striking price at 20 is going to act as static protection, act as protection even if the market goes up or down. So that's static. So in addition, when I'm talking about using VIX as protection, I'm talking about using it as disaster protection. In other words, I want to protect against the crash of '87. I want to protect against 2008, the 6-day crash. I want to protect against 2011 or protect against the flash crash in 2010. All those times VIX went up to like 50 or higher. And so I'm not interested in using VIX to protect my portfolio for a 10% decline. If you can't stand a 10% decline, then perhaps something is better for you, like bonds. But any portfolio of stocks can go down 10% and cover that pretty quickly. But to lose 40% or something in a matter of days, then that's a lot harder to get back. So that's what you want to protect with, in my opinion, VIX calls and options. So we suggest that you buy out of the money near term. In other words, we're going to stay near term, back with that same philosophy we had all along. And in order to simulate VIX, you need to stay near term. So we're going to buy out of the money near term calls monthly. We're going to hedge our full exposure. What do I mean by that? Well, if you're selling naked puts, then that would be the value of getting put on everything you have. Or if you're just in a cash account, then that's just the value of your account. Or if you're on margin, then it would be, double everything you have. In other words, you've got to hedge the notional value of your portfolio, not just the net asset value of your portfolio. Because, for example, with naked puts, the market goes down, you get put, all of a sudden you've got big problems on your hand if you're not hedged. So we're going to buy VXX calls when the term structure slopes down. Remember, that's beneficial to VXX. Or we're going to buy VIX calls if the term structure slopes up, which is most of the time. So depending which way the term structure is, that determines which calls we're going to buy. And how many we're going to buy. Well, this is a rough rule of thumb that I use. You can I can't prove this is perfect, and it, of course, simulates SPX, so you would have to adjust if your portfolio is more volatile or less volatile than SPX. But essentially, we're going to buy out-of-the-money calls about 7 points out of the money. That is based on the futures now. Remember, they trade off the futures. And we're going to buy 6 or 7 calls. I have 7 calls here. We're going to buy 7 calls for every $100,000 of exposure that I want to have. So if I have enough puts out there that if I got put in everything, I'd own $1 million worth of stocks, and I'd have to buy 10 times that, or 70 calls. That is my stock. So we, as I mentioned, we manage money in the option markets, and one of those, we kind of combine all these things in a way that I think is a bit unique. Let me just kind of review for that. This is a chart of the S&P 500 normalized to a price of 100 in December of '88. And the reason I put that there is because the CBOE designed their covered writing index, covered call writing index, the BXN, and they normalized that back to the same. And later on, the CBO came out with a put writing index, naked put writing index, again on the S&P 500, and that's the pink line. So you can see that cover call writing outperforms stock ownership, and naked put writing outperforms cover call writing. Now, you might be saying to yourself, if you know that much about options, you might be saying, well, I thought they were equivalent, naked puts and cover calls. Well, they are on paper, but in reality here in this situation, put writing is better for a couple of reasons. First of all, there's only one bid-ask spread, so we don't have to buy a stock and deal with the option spread. We just have put spread. Secondly, there's fewer commissions. If I sell a naked put and the stock goes up, market goes up, it just expires worthless. There's no commission to get out. But if I put on a covered right, there's a commission to get in, and then on the way out, when it gets called away, there's another commission. But those are minor effects. What's really going on here is that the out-of-the-money SPX puts are much more expensive than out-of-the-money SPX calls. In the CBOE covered call writing and put writing indices, they use out-of-the-money puts and calls. Why is this? It's a little bit hard to explain. Before the crash of '87, that was not the case. But since the crash of '87, it has been the case. It has to do with supply and demand. Institutions like to buy the out-of-the-money puts for hedging, and then they sell some out-of-the-money calls to pay for those out-of-the-money puts. Also, the clearing firms used to have very, very low margin requirements for selling an out-of-the-money put. They've raised those now, too, so that lessened supply a bit. Anyways, this is the kind of picture you might see with it. This is a while back, but with SPX at 1820. If we looked at these strikes, these were the implied volatilities. And you can see that the highest implied volatility is at the lowest strike, and the lowest implied volatility is at the highest strike. So if we were looking to do something theoretically attractive, we'd like to sell this high implied volatility and buy this lower implied volatility. So what kind of strategies work in that situation? Well, there's at least 3 that come to mind. One is a simple bear spread. That bear spread, we buy one here and sell one here. While it might have a theoretical advantage, that's going to lose money if the market goes up. But what about a call back spread? A call back spread, we buy two calls here, and we'd sell one call here. And, again, that's a decent strategy, but it does depend on the market moving. It's sort of like owning a straddle. If the market goes dead in the water, you're going to lose money with that strategy. So the one I prefer is this one, the put ratio spread, which is we buy one of these here, and we sell 2 down. So that gives us some downside risk, but it's way down there somewhere. And, that long put really helps that. So if the market falls into this range in here, this spread is making money all the way to here, and then it starts to lose some money after that. So we can adjust ourselves. And, of course, since there is a naked put here, we do have very heavy downside risk. And so we put together what we call the volatility capture strategy. The first part is a put spread like that using monthly options. The second part is we sell some weekly puts as well in order to bring in even more premium. And then the third part is we use the long fixed calls as a hedge against all these naked. So strategy has been working well. I think this year we're up 11% after fees coming into June. June was a slight profit. I don't know how, but we manage individual accounts. We're not a hedge fund, so you can see your account at the brokerage firm. We have only limited trading authority, so we can't steal your money like Tony Madoff. We issue quarterly reports. Of course, you get your brokerage firm statements. There's no lockup, no transparencies. And if you are a high net worth client, you can do a performance-based fee as well. So that pretty much covers everything I wanted to cover here. As I mentioned, if you go to this website, optionstrategy.com/cyber, you can get the PDF of this presentation. Also, we're offering 3 months of our primary newsletter for a price of $19, which is about half of what it is otherwise. Okay. Are there any questions that, let's see, are they in general chat? Or? All right. I don't see any question, but if you have any, oh, here's one. Let's see. Isn't the broker going to hold a large amount of option margin if you're naked puts? Yes, I mean you will have to margin the naked puts, and we usually margin them down to the point where the striking price is. So we allow some extra margin, so we won't get a margin call on the way down. There are some nuances to that. I've written some articles about how to deal with that. But yes, in other words, we're not maxing the account out on minimum margin. We're trying to allow for some downside movement without getting a margin call. The amount we manage, our accounts are $100,000 accounts. If you have any interest in the money management, we have a website for that. It's called McMillanasset.com. If you go there, you can find some documents, also find some performance, we can supply you with some performance data. Are there any volatility instruments specifically targeted at QQQ? There were, but they've been delisted. So right now we don't have a volatility future on the QQQ itself. Is the volatility capture strategy described in detail in the PDF? No, we don't describe it in complete detail anywhere. Obviously, it's somewhat proprietary. But if you want a thorough description of it, I would suggest that you call. Let me just advance one slide here. Call that number there. That's our office. Or send me an email. We'll get you some more specific information on it. All right. I don't know if Jesse's still around or not, but we're just at about our maximum time allotted here. So thanks for listening, and Jesse, I'll turn it back to you.